This is bad not only for Silicon Valley or startups, but the economy at whole. The Silicon Valley Bank failure could wipe out an entire generation of startups across the ecosystem and set back the United States 10 plus years or more in regards to innovation and startup growth. So what happened to Silicon Valley Bank? To find the answer to that question, we're going to need to look back to the year of 2020 when the COVID crisis hit and there was a huge influx of liquidity across the markets and especially within the ecosystem of the startup world. This liquidity flood, which has been seen as a Fed put, provoked a boom across the entire venture capital ecosystem and the markets. On the backdrop of a risk-on mentality, which flushed startups and founders with cash, Silicon Valley Bank positioned itself as the go-to bank across the entire venture capital market, and they enjoyed a huge influx of deposits. In fact, from 2019 to late 2020, Silicon Valley Bank's total deposits more than tripled, going from $61.7 billion in 2019 all the way up to $173 billion as of December of 2022. Now, the important question is what should Silicon Valley Bank have done with their $173 billion of deposits? With a compressed NIM spread, which is known as a net interest margin, which was a consequence of quantitative easing, at that time, writing loans was not very attractive. So with this, Silicon Valley Bank decided to park all of their excess liquidity inside of U.S. Treasury securities, as well as similar low-yield risk-free notes. And although these securities have been considered risk-free with the end of quantitative easing and the start of quantitative tightening, these securities ended up depreciating sharply in lockstep due to rising interest rates with the Fed. For reference, below is the 10-year chart of the iShares 20-plus year Treasury bond ETF, also known as TLT. Due to rising interest rates, suddenly Silicon Valley Bank needed to struggle with the falling price of its fixed income securities on top of the balance sheet. A balance sheet crunch was most definitely looming, and once the market woke up to SVB struggles, the meltdown materialized quickly. On March 8th, the parent company of Silicon Valley Bank, which is SVB Financial Group, announced that they sold $21 billion of securities from its portfolio at a loss of $1.8 billion and that they were going to issue $2.25 billion of new shares to shore up the company's finances. This decision unnerved a few prominent venture capitalist groups, such as Peter Thiel's Founders Funds, Coteau Management and Union Square Ventures, and a lot more. And these firms ended up instructing all of their businesses within their portfolio company to pull all of their cash directly out of the bank. And by March 10th, the effort to raise new equity or find a prominent buyer was completely abandoned, and the bank was put into receivership by the FDIC. The scary aspect of all of this is that 89% of depositors that held their cash and funds within Silicon Valley Bank are uninsured. So basically what that tells us is that drastic amounts of startups had way higher amounts than $250,000. And what that means is that the federal government is not going to basically cover them anything above $250,000. So there's going to be a huge ripple effect across the tech ecosystem and startups across every single sector. And it's going to be very hard for companies and startups to make payroll this upcoming week unless some magic is happening behind the doors and while we're filming this video with a potential buyer that can come into play. Silicon Valley Bank's collapse was caused by a distinct balance sheet composition that is not matched by major other banking giants, such as JP Morgan, Bank of America, and Citigroup, just to name a few. Reference, below is a snapshot of JP Morgan's deposit growth from December 2019 to December of 2022. As compared to more than a 200% increase for Silicon Valley Bank, JP Morgan's deposit base only jumped by approximately 50%, growing from $1.56 trillion to $2.3 trillion. What we can see here is that larger banks didn't go all in on overvalued U.S. Treasury securities. In my opinion, large major bank players are completely fine, and that's for now. Something for you to note is that banks are truly built on confidence of the people that bank with them, and once panic and nerves start to hit the market, anything truly in life, in my opinion, could ultimately come crashing down. I hope you guys found this video insightful. I loved making it and would really appreciate some support on the channel so I can keep you guys up to date on anything capital markets, Web3, cryptocurrencies, personal finance, and more. I will see you guys in the next video on the frontier. Cheers.